Our guest says these tariffs are just one factor that indicates that the US has broken trust with its allies, and this will have profound implications over the coming years. We're joined by Ed Develin, founder of Devlin Capital and former head of Canadian portfolio management at PIMCO. I guess we could, great to have you. I guess we could also mention defense as well. Trump is,
100%.
yeah. But I guess our modern society runs on trust.
Absolutely. It's the basis of credit. It's trust. When you extend credit, you're trusting people to pay you back. So, yeah, our highly leveraged financial system globally, and that has been built on a U.S.-led, rules-based international order, is kind of gone. And so the real question is, what replaces it? Is it massively different or just somewhat different? But the old Humpty Dumpty, sometimes when you fall down, you can't put it back together again.
So the U.S. has been at the center of the world economic system essentially since the Second World War.
Correct. Since Bretton Woods, and think of the UN, the WTO, the IMF, the World Bank. These are all U.S.-led efforts to, with the Marshall Plan, the rebuilding of Europe, and then, they have the reserve currency, the exorbitant privilege, that they have with that, and all these they're not going to go away tomorrow, but they're all being damaged. The U-turn on the Ukraine. It's got the European allies head spinning, right, kind of thing. Is it really Europe against? It's definitely Europe against Russia, but is it now Europe against Russia and the U.S.? I mean, the U.S. is not being friendly. So there's negotiating, and then there's a breaking of trust. And, I think the trust has been broken. Just how badly broken has it been? Hard to see. Because even when Trump's gone and the next person comes in, look what Biden was in for a bit, and he tried to repair it, right? But it was diminished a bit. But what Trump's doing, version 2.0, is much more significant than the first term.
Bretton Woods, of course, was the system established in 1944, partly to ensure exchange rate stability and to stop countries devaluing their currency to get trade advantages.
Exactly. Getting rid of what Trump believes in. He's a 19th century mercantilist. And Bretton Woods was to get rid of that 19th century mercantilist mentality and move us towards a more modern financial system.
Are you being kind to him? I thought mercantilism was gone by the 19th century.
Well, I think the Chinese implemented it pretty well in the last 20 years, by depressing their currency. Yep. And so the Chinese have been have had bad behavior, and it's very debatable whether they should have been included in the World Trade Organization. But they definitely abused the privilege once there. So there's some things, Donald Trump, there's often a few kernels of wisdom and truth in some of his plans. His execution often leaves much to be desired.
You've spent a lot of your career watching bonds.
Yep.
Would you be a buyer of Canadian 10-year bonds today with the yield well below 4%? Say your time horizon is 5 years. 5 years?
Yeah, probably yes, I would say. I think it's come a long way. So you and I were talking last year when the policy rate was at 5, and I was saying it was going to go to 2, and now the market's pricing 2. So I think we've squeezed a lot of the juice out of that lemon. I think there's probably a bit more to go, but it's going to be highly dependent on, it's path dependent on, what is going to happen specifically with tariffs and how this quote unquote negotiation plays out. Does it play out quickly, or does it play out over a prolonged period of time? And what's the amount of damage that gets done to the real economy here in Canada because of it? I think it's going to be significant. So, that's why I would say probably more of a buyer, at here. I think it's about 280, 285, something like that.
Sorry, the 10-year. Let's put
yield.
That up again. Yeah,
I think the 10-year yield's around there.
It's a miserable yield, but it may be one of the best deals out there.
But, right now, if we end up in a recession, we could end up with a policy rate at 1%. And then, 285 looks pretty good.
Yeah, because our policy rate now is 2 3/4.
Correct.
You see it coming down to 2% this year, Ed?
Well, the market's pricing that.
Okay.
So the market right now is pricing that there'll be effectively 3 more rate cuts down to 2% by the end of this year. So, I always, as an investor, have to bet against the market, what's priced in. So the market has come around to our way of thinking. We've had a very good run in the last year or so. And I think that, probably there's a bit more, but, we've come a long way. So, in the last, yesterday we took a little bit of profits, and probably today we'll take a little bit of profits again, but we're still overweight, the bond market.
If you were renewing a mortgage this summer, would you go variable rate? I know you don't want to, you're not professing to be an advisor in that sense, but would you think about a variable rate mortgage?
Yeah, but I take it over the short term. I take it over, because I wouldn't want to lock in a variable rate for too long, because I do think, when you get a decent 5-year rate, then you should lock that in.
That's right. I mean, with this drop in bond yields, 5-year rates are going to be pretty decent.
Right.
Yeah.
So your real question is, will 5-year rates drop more in the next year? And I think the answer to that question is probably yes.
It's amazing. Excuse me. It really feels, as you say, with this broken trust, we're in shifting sands now. It's a point of world history like that.
Well, the one thing I find very interesting, so our portfolios have been constructed to take advantage of what we call left tail risk, which this is the market really goes down the toilet. And we've been positioned for this for a while. And yesterday was actually our most constructive day ever in the last year or so, because we have been very underweight corporate bonds. Corporate bonds are very linked to the stock market, right? Because they're, it's either a stock issued by a corporation or a bond issued by a corporation. And if you look at what's gone on here is there's always the initial conditions that matter the most. So S&P 500, at nosebleed levels, the Mag 7 with Tesla trading at 190 times earnings. It was an accident waiting to happen. We just didn't know what was, you have a big tank of gasoline. We just didn't know what the match was going to be. And the match turned out to be these very silly tariffs. And boom. And now so we're now in we're going to correct. And in our view is it's going to correct more in the short term. We'll see how it plays out in terms of these negotiations. But when you start off with an asset that is fundamentally expensive,
what's the asset? Sorry.
Corporate bonds or the stock market. I would say the S&P 500 or Canadian corporate bonds. And so, by not owning any of them, we've been massively outperforming the market.
Give us a final thought. If we do get a sustained trade war, that presumably will be, I know we're going over ground here, but that will be a decent reason to own bonds, won't it?
Yes, but I would like to own government bonds, not corporate bonds.
Yes.
Not yet, anyway. Corporate bonds make sense at the right yield or spread above a government bond, but when they get too tight, they're rich, like any other asset class. And they were rich before. They're starting to correct. They're correcting pretty meaningfully now, and just like the stock market's starting to correct. And I expect both the stock market and the corporate bond market to correct meaningfully more in the weeks to come.
Ed, thank you very much.
My pleasure.
Ed Develin, founder of Devlin